Hello, class. My name is Bradley Walker, and today I want to explain to you why the financial industry was the direct cause of the economic meltdown in 2008. All right. The crisis started because many financiers in the industry believed that they had found the key to alleviate risks that was associated with loans and securities that had extremely high risk. It was needless to say that they were incorrect. Um, One of the main counterparts of the economic meltdown was something called subprime mortgage loans. A subprime mortgage loan is a loan that is issued out to consumers that have low credit ratings. To compensate themselves from the higher risk associated with these consumers that had low credit ratings, financial institutions would charge higher interest rates, and sometimes they would charge variable interest rates. They called some of these loans ninja loans because a lot of these consumers did not have any down payment, they didn't have any income, they didn't have any jobs, and they had absolutely no assets. Knowing that these consumers did not have any of the above, a lot of these financial institutions pooled all these more subprime mortgages together and sold them to bigger banks and securities. Now, pooling loans together works if the loans are not directly correlated with each other. And what the big banks believed is that the American property market would rise and fall separately from each other. The theory was incorrect, and in 2006, there was a huge slump in the market all over the nation. These mortgages that were pooled together were used to back up something called collateralized debt obligations, or as they say it, CDOs. A CDO is a product that again pulls together cash flow generating assets and repackages them into discrete tranches to be sold to investors. Now, some of these senior tranches of these CDOs had extremely high credit ratings, and again, they were sold at a lower price to compensate for the higher risk associated with the loans going into default. Hundreds of billions of dollars were invested and assigned the AAA credit rating that was very inaccurate. Investors actually went after these particular CDOs because they appeared to be very attractive and safe while receiving higher returns with the lower interest rates. Banks, investors, hedge funds all sought after these low interest, high return, riskier assets with AAA credit ratings. What occurred was many investors borrowing money into money markets for longer periods of time on higher yield securities because they appeared to have short-term interest rate stability. Once the housing market completely turned, the domino effect occurred, and these pooled together loans and securities did not protect investors like they assumed. Consumers that held the subprime mortgages found themselves owing more money on the home than the home was actually worth, with increasing interest rates on the ones that had the variable interest rates. The majority of these loans went into default, and the entire foundation of the financial system created by the financial industry caused the economic meltdown. Mortgage-backed securities that were pooled dropped in value. CDOs that had the AAA credit rating, they were absolutely worthless. Credit default swaps were supposed to spread risk. Now we're actually concentrating the risk with these loans. So, in conclusion, the entire system was built on an extremely high risk by the financial industry. They took a risk on these subprime loans with consumers with very extremely low credit scores. They gambled and they lost with the gamble that they tried. So that's it. Thank you.